Hi, in this video we're going to work problem E10-8 from page 569. It's a held-to-market debt investment set of transactions. So we're going to journalize the transactions related to a bond. And sorry about that. And so here we go. In this problem, we've got a company called Griffin purchased a bond on January 1, 2018 for $140,000. The bond has a face value of $140,000 and matures in 20 years. The bond pays interest on June 30 and December 31 at a 3% annual rate. Griffin plans on holding the investment until maturity. So you should be familiar with all these terms from reading the book and watching the lecture videos. If not, you might want to go back and look at that because it's important you understand, what the term face value and bond interest mean. All right, so basically Griffin has purchased an asset and they're going to hold it to maturity, which is the only kind of debt investment we're going to do. Your book has other kinds of debt investments, but for our purposes, we're just going to assume that if a company we do the accounting for purchases a bond of some other company, well, they're going to hold it to maturity. And so that's called a held to maturity debt investment. So we're going to do the journal entries for 2018. So obviously they bought it. It pays interest twice a year, so we need to do that. And that's the journal entries for the year. So the first journal entry is on the day they buy it, right? So on January 1, we get the asset. I'm going to just abbreviate HTM. That stands for held to maturity. Debt investment. And of course that was $140,000. So now we have this asset. It's a long-term asset. And we've got it on our books now. And of course to buy it we had to pay cash. So we decrease the asset cash by that same $140,000. All right, so now that asset is on the books. All right, the next thing that happens, like it says here, it pays interest on June 30 and December 31, and it's 3%. It's that annual rate. So you may recall our formula. I'll just write it down here. Interest equals principal times rate times time. Remembering that when they tell us rates, they're at annual rates, but the time is however long the interest accrues over. So in this case, it's from January 1 through June 30, so 6 months. So I is equal to principal, which of course is our $140,000, times the rate, which is 3%, 0.03, times the time, which is 6/12 or a half, right? So 140,000 times 0.03 times 0.5 is equal to 2,100. All right, so my debit and credit are 2,100. Right, 2,100. And of course, that's cash that comes in, right? When we get paid interest, we get some cash in, right? They gave us, for lending them that money, for lending them $140,000, they paid us $2,100 over 6 months. And of course, that is what we would call interest revenue, right? We earned it. Interest revenue. We earned that interest revenue. All right, so the next transaction for 2018 comes when they pay interest to us again. So we receive interest again, and of course it's the identical amount. I don't have to redo 140 times 3% times 6/12. I just know that I'm going to get cash of 2,100 and interest revenue of 2,100, and it just goes on the books. Now, in theory, we're going to hold this bond to maturity, and so every 6 months from now to when it matures, this same transaction happens. So on June 30th of 2019, they'll send us $2,100. We'll record it this way. December 31, 2019, record it. And all the way out until it matures, which is in 20 years. All right, so 20 years from when we bought it is December 31, 2037. Right, so every 6 months we've been getting the same $2,100 and booking it the same exact way. Now it's matured, and now the transaction becomes disposition of the bond. So the people who we loaned that money to, that $140,000, now we get the $140,000 back. Because remember, the whole point of this was a loan, and this is the interest. So now, at the end of the bond's life, the organization we lent that money to repays us the $140,000. So now we get in cash of $140,000, and we no longer have this asset, so we take that off the books. HTM, held to maturity, debt, investment, 140. And that's it. Now we no longer have that asset, and we got the asset cash back instead. So that's pretty much it. I think the key to this is understanding how interest works, which we've already learned. I equals PRT. Remembering that interest is always an annual rate, and time is however long they have it out. So if you had a bond that paid every 3 months, this could have been 3/12, right? Some bonds pay annually, so then you wouldn't even have to worry about it. It would just be times 3%. Anyway, that's it for problem E10-8. These are the kinds of things you would have to do on the exam for a bond. None of the other kind of bond investments where a bond is held available for sale, we're not going to do that. So the only kind of bond investment is this held to maturity. So you have to put it on the books, accrue interest, and receive interest, I guess I should say, and maybe take it off the books. All right, see you on the next video.